welcome back to the Trader's Edge podcast. I'm Jim Urio. As always, co-host, brains behind the operation, Bob Iacino. If a lot of you guys have watched our normal podcast, The Future's Edge, Trader's Edge is a little bit different. Trader's Edge, we're going to talk about macro, and we're going to bring it down to different markets, different assets, and how we are looking at them. Occasionally, we're going to have guests. Today, we have a great guest. Today, we have the president, CEO of Bianco Research. You guys all know him. It's Jim Bianco. He's going to be coming on a second. Bobby, what do you think is the most important thing we should be looking at today?
I think we should go over these FOMC minutes and Jim's view on inflation, because Jim has been staunch in his belief that inflation was going to tick back up from the base that we've probably already seen. So I'm really curious to see what he thinks now, given the data we've had.
Right. And when I disagree with Jim Bianco, it's very, very rare, but it gives me pause.
It's also very stupid to do. Yeah.
Well, yes, I know. It would not be the first stupid thing I've done, as you've known. But without any further ado, let's bring on Jim Bianco. James, how are you?
I'm doing good. Those are impressive graphics. You're going to trick people into thinking you know what you're doing.
Exactly.
That's the whole reason for those graphics.
We've been tricking people for a long time. Yeah. First of all, I'm going to apologize for saying without further ado. I'll never say that again. I don't even know where that expression comes from. I understand the French, so I'd like to apologize. I'm not going to be kicked out of the Guy Club for that or anything. But Jim, all right, good to see you. How's everything going? Good?
Yeah, it's going good. Enjoying the summer here in Chicago. How about you?
This is the time of year where in Chicago, Bobby, you might have forgotten about this in Florida, where we're all like, crap, summer's almost over. We got a million things we need to do. Got to go to Ravinia again. Got to go to more ball games. So we're going to Cubs game on Friday. So that'll be fun.
I actually just mentioned that to my wife the other day. I said, you realize that back when we lived in Chicago, this was the time of year where we started to panic that we were about to be cold. It felt like the next day, but it's really like another month and a half, 2 months.
Yeah, exactly. It's not till early October that you really have to start worrying about it.
Right. Okay, Jim, I don't know if you heard us when we were introing you. We were talking about how for a long time, I thought that we were in a period of disinflation. I thought that my reasoning is that I believe the supply chain was healing, and it still continues to do so. I think the federal government is still doing inflationary and stupid things, but not as inflationary stupid as they were before by pumping money directly into people's accounts. I understand that unions are arguing for higher wages. I understand that services still there. You think, hopefully I'm not misquoting you, you think inflation is going to tick up. Can you give us an explanation as to why?
Yeah, I do think that inflation on a year-over-year basis, year-over-year CPI hit 3% in June. It hit 3.2% in July. It's probably going to be about 3.6 to 3.8 for August. And that June will eventually wind up being the low print on a year-over-year basis for the year. Now, it may not go much higher than low fours, but it isn't going down any further than that. So that's at least what I've been arguing now, for pretty much the bulk of the summer. I've been arguing bigger picture that we are in a post-COVID economy. That is a different economy. So whatever rules we were using in 2019, we can leave in 2019, and we have to come up with a new set of rules for this economy. Things have changed. Work from home is something I've talked to a lot about, that it is just a very visible sign of how things have changed. The economy needs to be restructured. It needs to change. It can, and it will. And when it does, then I think inflation will settle down. But the problem is, we don't want to change the economy. We want to have an argument about whether or not it needs to be changed. Oh, no, everybody's lazy. Get out of your pajamas. Go back to work. Things are going to go back to the way they were. No, they're not. Now we need to start to change things. And once we do, then we can see inflation settle down. Until then, we're going to have a friction that is going to keep inflation elevated. Now, 3.5 to 4.5 elevated, not 8.10 or Zimbabwe elevated, but 3.5 to 4.5 elevated. What that means is that fair value on the 10-year note, and we'll talk more about this later, I assume, is going to be like 4.5 or 5. We're at 4% right now. So I think we still have higher rates ahead of us.
So when I hear you say that, what I think you're saying is that you don't see any sort of calamitous recession coming that would cause the Fed to ease. You look out at the Fed funds futures curve that's predicting eases by May, and you think that's nonsense also, correct?
Yeah, and on the first part of your question, yeah, the recession that everybody's looking for, it was last year. It was last year when you had the 2 negative GDP quarters and the 25% decline in the stock market, and all the great economic poobahs said, this is not a recession. I actually think it was. I think we already had it at this point. I think looking forward from here, you might have some period of subpar growth, sure, but I don't think we're going to have a recession. Wall Street settled into this term soft landing. I love soft landing because it's undefined. So if you say we're going to have a soft landing, you're not wrong because you could define it any way you want to define it. Because half the crowd defines it as being a mild recession and half the crowd defines it as being just subpar growth. So we don't know what that is. So sure, I think we're going to continue to have growth, and that is going to continue to push on prices and continue to keep the heat on interest rates.
So 2 questions, Jim, then. If we had the recession already, we obviously have had an earnings recession. That's happened. I would argue that we're kind of still in the midst of it. Do we end up having a jobs recession, or do we skirt that?
Well, I think the problem with the jobs market is it has changed in ways that we don't understand. Being all three of us are Chicagoans, the Haymarket Square, which is a mile west of the Loop, was where the 8-hour 5-day work week was invented during the Haymarket Square riots of 1888. Now, the reason I bring that up is I think what's happening to the labor market is the biggest thing since then, that we're going away from the 8-hour 5-day work week, and that we're changing because of work from home and flexible work and everything else. Now that I've said that, I don't think we really understand the labor market. And what we see in the labor market is persistent strength. I think what's happened with the labor market, if I had to guess, is that it's become more transactional. Now, that's a fancy word again. What does that mean? People, especially at the lower end, they'll float in, take a job for a few months, earn some money, and then they'll float out and they'll go ski in the Rockies for a few months, and they'll find another job to kind of make ends meet in the spring. And that's become more acceptable. That was frowned upon as late as 2019. Sure, if you graduate from college and stuff, you want to start a career and be a little bit more traditional. But I think the labor market is fundamentally changing. So I wouldn't be surprised if we don't have the traditional labor market setback. Look, we're talking here in the middle of August. Last thought for you is that almost a year ago next week was Jay Powell's famous 8-minute speech at Jackson Hole, which has been dubbed the "there will be pain" speech. Hey, where's the pain? Stock market's up 9%, and we have a 3.5% unemployment rate, which is lower now than when you told us we were about to have pain. I think what we need to do is we need to not just mock Jay for being wrong, but say, look, in August last year, we all thought that was a layup trade. We all thought that was absolutely obvious that that's what was coming next, and that's not what came next. And so we need to start to really understand that this is a very different economy.
So we can mock Jay Powell at the same time, though, right? I mean, You're not taking that option away. Okay, good. We have to make sure of that, because I mock him absolutely for June of 2021, where CPI had already printed over 5%. The housing market was obviously on fire. And he said, let's keep the pedal to the metal a little bit here, while everybody like you and me and Bobby were screaming at him, no, we shouldn't do that. Let's talk about the implications.
You know what he needed? He needed Janet Yellen's magic mushrooms back then. That would have taken care of the problem.
What is the story on that? Did she go to China and admit to having magic?
That is crazy.
Having how do you pronounce it? Psilocybin or whatever it's called. Did she admit to that?
Psilocybin mushroom.
Psilocybin, exactly. Yeah. Was that the story?
Yeah, she went to China last month, and she went to a dinner, and they served magic mushrooms, and she didn't realize it, and she started hallucinating. And that's, if you've seen the YouTube videos of her like bobbing and weaving and doing crazy stuff like that.
I don't believe that angelic face for a second. She knew what she was doing.
Yeah, well, that was the best call that she's made in her career.
No doubt about it. If by the rare chance that you're listening to this podcast, we want to party with you. I've never done magic mushrooms, but if you want to sit around and we'll do them, it'll be fantastic. So anyway, let's get rid of that. But I want to talk about asset prices, stocks. If rates are staying high for a long time,
we're back on asset.
Not asset prices. Asset.
Oh, I get it. Wow, I'm slow to the uptake here. Stocks. If rates are staying high, There's no value in stocks, is there?
Well, it depends on which stocks you're talking about, because we've bifurcated the market into the Magic Seven or Magnificent Seven, those big mega cap tech stocks, which are on their own cycle. That they're running on this idea that AI is coming and it's going to change the world. I agree with that. AI is coming, it's going to change the world. But I would just say history shows that the market tends to overestimate the short term and underestimate the long term. You might have gotten these stocks a little bit ahead of themselves in the short term, meaning the next year or two. But over the next 10 or 20 years, maybe those changes that we think are coming are going to be bigger than we think. But you've got those 7 stocks on their own cycle. Those 7 stocks are 2/3 of the gains in the S&P. Now, if you look at everything else, the other 493 stocks, you don't see as big a gain there. And I do think that that's because even though I said, look, no recession, things are going to be okay, low unemployment, does that mean buy stocks? No, that means more inflation. And that means higher interest rates, and that's dragging. When you get to the Russell 2000, the small cap stocks, there's another index, I might add, called the Russell Microcap, which is actually the lower 1,000 of the 2,000 in the Russell 2000. It turned down on the year yesterday. Yeah. So it's those stocks have those second half 1,000 stocks in the small cap, which I would argue to you are more aligned with economic growth in the U.S. than Apple is. Those stocks, no gain this year in those stocks. And why? Because I think that the problem is cost of capital, fear of recession, or not fear of recession, fear of inflation, excuse me, and that's going to keep the heat on the economy, that we're going to have higher inflation, not necessarily weaker growth.
Okay, so 2 quick things. Yesterday, we recorded our other podcast with Art Hogan. And Jimmy, if you remember, I said, somebody said that I heard somebody say that in terms of AI, we tend to overestimate the short term and underestimate the long term. And I said I couldn't remember who said it. It was frickin' Bianco. So now I
Bianco, right?
Credit. If anybody watching, including you, Jim, watches that show we did with Art Hogan, you'll hear me say I can't remember who I heard say it, but I want to talk about it. So Art said some of the same things you just said, and I'm glad you brought up microcaps, because I keep looking at the IWC, which of course is the ETF for microcaps, and I want to buy it, and I can't find a spot technically that looks good. Do you think there'll be catch up there?
Eventually there will be catch up, I think, once we get further down in this cycle and we eventually see that peak in interest rates, because those companies are so tied to inflation and interest rates, more so than, like I said, a Nvidia or a Microsoft or a Netflix or an Apple. So I'm not ready to go there yet. I don't think there's a lot of downside for those companies right now, but I do think that what their struggles are showing is, when we ask, are we seeing the impact of all of these rate hikes? Yeah, we're seeing it down there. We're not necessarily seeing it in the big cap stocks. Also, when you get to the micro cap, those companies are not dominated by ETF flows. They're not dominated by this mechanical, everybody is got a 401k and they check off the little box to buy the Vanguard S&P 500, and the money just flows into the market without regard. Those companies are more economically sensitive. And that's why I think it's important to note this gigantic divergence, that they're kind of unchanged on the year, while the rest of the market is the big cap companies are really flying.
Jim, the second part of my question is going to be about the shape of the yield curve. But as you just said, something dawned on me. When you look at the banking industry, there was 15,000 U.S. banks 30 years ago. Now there's 4,000. When you look at the big cap tech names gaining ground and the smaller companies not, you read our good friend who was just mentioned on the Russell Brand show with her new book, but you read her book, Too Big to Fail. The Death of Small Business, or I can't remember what it's called exactly. But do you think there's something that's sinister at all on a governmental level that would prefer? This is an important question. It's about policy. We don't talk about politics. Is there something sinister that both parties would love just a handful of big companies because they're easier to control? Am I just off the reservation?
Well, you're wrong there. It's easier to shake down. It's not easier to control. Yes, no, they do want they do want the more consolidation because it's easier for them to shake those companies down. There's no doubt about it. But they run into a reality that 1/3 of the American workforce works for a company of less than 100 employees. I do. I think you guys do too, right?
Yep.
You are less than 100 employees. And half of the American workforce works for a company of less than 500 employees. So yeah, we want to be France, and we want to be, have every industry have 3 companies, and every company have 18,000 employees, and then we want the government to basically run those 3 companies in every industry. But the reality is our economy has never been structured that way, and as much as they want to see it to, be more concentrated, they're never really going to achieve that because they're never going to get that job growth that they think that they're going to have. Otherwise, if you want to turn us into France, then we're going to go all the way with France, right? And we're going to be burning a couple thousand cars in a week, in protests and everything else that they have in all the unrest that they have in those countries. So,
but a lot of vacation.
Yes. But a month of vacation. We wouldn't be holding this podcast in August, right? Because we'd all be on vacation.
Jim B, this show is a little bit different because it's live, and when we see a viewer question, we take it, we put it up on the screen, and we ask you the question. So I want to do that right now. It's up on the screen. Would you say that 3% is the actual number for inflation, and can the CPI and PPI numbers be trusted? Now, I don't know if MM means is 3% a real number, or if he means is that the number inflation is going to get to. So take that question however you want. Can we trust the figures themselves?
Well, I think we could trust the figures themselves. Let me start with that because of what they're attempting to do with those figures. Look, the Commerce Department is very transparent in the way that they calculate PPI and CPI. If you want to argue that they've got some errant assumptions in there, sure, we could argue that, but I don't think that they're being sinister. So I'm not in the tinfoil hat crowd, at least on the second half. The first half of the question, I interpreted it to mean, is the long run rate of inflation, the Fed's long run target, 3 as opposed to 2? That matters. It may not sound like that it matters, but it does, because the Fed has already said that they think that the neutral funds rate now is 0.5% above the long run inflation rate. Okay, so if the long run inflation rate is 3, then that means neutral funds rate's 3.5. When the yield curve normalizes over long periods of time, it should be that the 10-year yield is 150 basis points or 1.5% above the funds rate. Now, the yield curve's inverted now, but that's a unique situation. Most of the time, it's normally sloped. So if you have 3.5 as your funds rate target, because it's 0.5% above 3, and the yield curve goes to 150, its normal shape, that's a 5%. That's 5% on the 10-year note. That's neutral. We're at 4 right now, and that suggests that interest rates are too low. So that's why it matters. So yes, I'm in that camp. That if the question is 3% the long-term target, I'm in that camp that yes, it probably is, and maybe even be closer to 3.5, which would put the 10-year closer to 5.5 if you run through all that math.
So number one, will they say we've changed our target, or will they just say we're still working on it? And then number two, the real question I have, so there's some people out there saying, actually one specific person, but I'm not going to name her because I think it'd be shitty to do that. She basically said that I don't understand why people still think there's a lot of inflation. Inflation has come down 6% from the high of 9 to where we are now. And I actually have my own reason for that. I think it's because inflation since the first quarter of 2020 is up over 18% and ECI is only up 14%. Why do people still think they're struggling if inflation has come down? And I don't remember the other question. So go ahead.
You hit it right on the head. That since the first quarter of 2020, that's the end of the recession.
Right.
Prices are up 18%. In fact, I was looking at that exact chart not an hour ago. Prices are up 18%. So that means that, you need $118 to buy $100 worth of goods that you were buying 3 years ago. All right, but you got a raise. You only got a 14% raise is what you wound up getting. So you're losing ground. So if you are somebody, the studies say 60% of the workforce lives paycheck to paycheck. They don't own a home. They don't have a portfolio. They're not traders. So if they're getting a 14% raise over 3 years, when prices go up 18%, they're just forced to buy less things. and they're forced to be squeezed. And that's why the president's approval rating's down and everybody's grumpy, because they can feel that squeeze. Now that I've said that, Jay Powell, I believe, understands that. And when he does his press conference, he reads the same boilerplate language at the beginning of every conference. And we ignore it because it's the same thing every time. But what he says is, we understand the hardships that inflation causes. If you continue to have inflation, it hits the poorest, it hits the lower end of the economy harder than the higher end of the economy. And with inflation problems, you don't have a real economy. I'm going to translate it. We're never raising our target to 3%. We have to get the inflation rate below wage growth. That's where it was from 2010 to 2019. That yes, your salary went up faster than prices at the store, so you could progressively buy more things every year. But now we're in reverse, and I think in the long term that's an untenable situation. I think Jay Powell knows it, and that's why I think he's been keeping the heat on, and that's why he's raised rates so much. He wants to get the inflation rate down. He needs to cool the economy. That's why he gave the speech a year ago that there will be pain. But the problem is, I think the economy's changed so much that the typical rules that he's using aren't really working.
Jim, for about a month or so, I've been arguing about a certain concept, and about, Milton Friedman famously said that monetary policy has a long and variable effect, whatever, to feel its efficacy. I've argued this: the 10-year yield in the 5 years before the first rate hike averaged 1.96%. The average 10-year yield since the 80s is closer to 6%. My belief is that in that 5-year period, everybody who had the chance, and that goes from businesses, S&P 500 companies, to individuals, rolled into duration. And the hikes right now don't have the efficacy as they've had in the past as far as the swiftness to feel them, because so many people are sitting back going, wow, sucks to be you having to get a mortgage at 7%. And companies are saying the same thing. Is this a very specific point in time that makes this rate hike cycle different, and that we're not going to feel the effects until later because of what I laid out?
I think that, where we are with this, the long and variable lags, this is the big argument, right? 500 basis points of rate hikes that has to have impacted. The Fed has done some studies on this that I've read, and Jay Powell cited, last year, that I kind of thought he was going in this direction, that those long and variable lags are kind of more short and immediate right now. The market, the big parlor game in America seems to be, point spreads on the NFL and betting on the Fed next rate hike. That's because we've got the Fed fund futures. Everybody's got an opinion about it. We see it in the markets immediately, and the Fed does forward guidance. They tell us what they're going to do. So the point of all that is that in the impact of monetary policy is a lot quicker, is what it winds up being. Long and variable was back in the 90s and the 80s when we used to argue, did the Fed raise rates? I don't think they raised rates. Did they raise rates? They never ever had a press conference. They never really told you. It took you 6 months to figure out what they were doing. Now they tell you 2 meetings before they're going to do it, what they're going to do. So I think
what
that
they
it's more
think they're going to do, right?
Right.
What they think they're going to do. Okay,
right.
Yeah.
And then they adjust it along the way. But the point is that there's no ambiguity there when you get to the meeting. So it's more short and immediate. Now, if it is, what does that mean? That means that maybe 500 basis points of rate hikes has really only taken us from easy policy to neutral policy to slightly restrictive policy, which is why the stock market is rallying. The overall indices are rallying. The unemployment rate's at 3.5%, and we might not have a recession. We're not nearly as restrictive as we think we should be. And we kind of shrug that off with, long and variable lags. You wait. Next year, everything's going to fall apart. Well, of course, anything's possible. But I think it's more likely
beating to death my thesis.
Yeah.
Well,
but I think more likely we haven't gone far enough is where I'm at. Look, I'm a bond bear right now. We haven't gone far enough. And if we're going to continue to have 3% inflation, going back to the previous question, that is going to be unacceptable. And we're going to have to do something about that. And the Fed's only got one tool, and they're going to just keep bludgeoning away with higher rates until they see something on the inflation front.
So this is interesting, and bear with me a second because I'm going to read a couple of paragraphs from the FOMC minutes today. Again, we're not recording right now. This is live. So the minutes just came out, what, hour and a half ago or so? And two paragraphs that stuck out to me. Participants commented that monetary policy tightening appeared to be working broadly as intended. They noted the recent reduction in total and core inflation rate. However, they stressed that inflation remained unacceptably high and that further evidence would be required, blah, blah, blah. So to what we talked about earlier, Jim, about the gap between what wages have gone to and what things still cost, right? Listen to this. Participants also observed, however, that although growth in payrolls had slowed recently, it continued to exceed values consistent over time with an unchanged unemployment rate, and that nominal wages were still rising at rates above levels assessed to be consistent with the sustained achievement of the committee's 2% inflation objective. So are they saying we need people to get further behind first before inflation will actually come down and match their wages? Or how am I reading that right?
I've read that same variations on that passage. I didn't read the minutes yet from today, but I've read variations on that passage, and I've had that same question. Are you saying, is the Fed saying that the secret to bringing inflation down is to make everybody poor? I hope that that's not the answer. I think what they're trying to say is that as long as wage growth continues at this pace, you can never really get the inflation rate down. The inflation rate can run below wage growth, but just slightly below it is what it can. You can never have like 4% wage growth and 1% in price growth so that you have a real 3% increase every year. You could do that maybe as an aberration for a few months or several months, but not consistently. So I think what they're trying to say is at something like, mid fours or low fours on the wage growth level, even the high threes, that won't get us to 2% inflation, and that we need to see further slowing in the economy. Now, how are we going to do that? Are they, that's when they say that, people jump up and down and say, that means you're going to unemploy people. That means you're going to make pain. Well, maybe, but to date, there hasn't been any pain. Claims are very low. I know the number last week jumped, but then that might be because of the Hollywood writer's strike with 460,000 people out of work right now. But beyond that, claims are very low. We're still pumping out 200,000 jobs a month, and we have a 3.5% unemployment rate. So we haven't really seen that pain in the labor market.
So,
by the way,
Jim,
I feel bad for the Hollywood writers until I see like Seth Rogen out there and stuff. They should just keep the big names out of there.
I agree because 460,000 workers, a lot of those, we all know that, in Hollywood, there's two people in Hollywood. There's people that make $30 million a film, and then there's people that have to wait tables to pay their bills. And the vast majority of them are those that have to wait tables. And when you drag out $30 million picture actors to try and act like they're common people, I don't think that works.
Right. There's a girl who works at the coffee shop that I go to in the Board of Trade building, and she had just signed a contract to do a pilot in New Jersey with some big names. She told me who it was, and that's all been canceled because of the writer's strike. And so there are people who are like just breaking in that this comes at a terrible time for. Before we let you go, though, Jim, if you look out at the next year, as far as like what assets could do well, what assets will do poorly, what's the trade in your mind? Not asking for advice for anybody, just what do you think you're going to put money to or do?
Well, I think that there's a couple of trades in there. I'm going to draw a bigger picture. I think that stuff will do better because inflation will be still an issue. Again, not Zimbabwe, but enough that it will be an issue. Kind of within the stuff category, which is commodities.
We get it.
I think that oil is getting ready to go. Oil's going. It's up 25% in 7 weeks. And I think it's not done going. It's going to continue to go. You got two things going on with oil. You've got demand really, really picking up a lot, even with the mess that China is. You've got demand picking up, and you've got OPEC insistent on holding the line on production to try and get the prices higher. That's a powerful cocktail to continue to see prices go up and also feed into the American CPI numbers as well. Away from that, I think that risk assets like the stock market are going to run into trouble because TINA is over. There is no alternative. There is now an alternative. That alternative is a money market fund at 5.5%. Now, University of Chicago has done some long-term studies that over long periods of time, the stock market should return about 9% a year. Over the last 2 years, it's returned zero. It had a good run before that. So that 9% number still seems to be holding. Well, in 2019, if you said, look, long-term, the stock market's going to give you a 9% return, but if you don't like the stock market, you could go into a money market fund and earn zero. That didn't sound like a good deal. But in 2023, if you said, look, the stock market's still going to give you a 9% return, but if you want to elect out, you could take zero risk and get 2/3 of that gain with about a 5.5% money market fund. I think that people are going to look at that and take that. So I hear people on Wall Street go, oh, those people in money market funds, they're fine. They're very happy getting their 5.5% without any risk. They are not kicking themselves that they didn't buy NVIDIA last year before the 140% run up. That's not that type of style. But I do think that as rates continue higher and as that 5% goes to high fives, maybe short-term bond funds can even yield into the sixes, it's going to provide real competition for the flows into equities, because people will say, that's good. That's good for me, especially if you're older and you're nearing retirement, and without any risk, and I could sleep at night. So I think that that's going to provide some kind of a trouble there. Other than that, since you're a trader show, TBT, which is the inverse TLT, ask me in a year how that goes. I think that, yes, that was a fantastic trade last year, probably the best it's ever been. And I think from this moment forward, that would probably work again. Look, I'm a bear. I think that August of 2020 ended the 39-year bull market in bonds. We are in a multi-year bear market in bonds, which means we're going to continue to see higher and higher rates. And so when we're in a long-term bear market, like I like to say, my default is bearish, where prior to 2020, my default was bullish because I think the longer trend is up. So if I'm going to make a mistake, I'll make a mistake by being bearish when the market rallies, as opposed to the other way around.
So Jimmy, if I could seal you for 2 more minutes before we let you go. First, funny thing, you mentioned that University of Chicago study with that 9% a year in the S&P. When I was at my fund of funds on the investment committee, one of the things I used to tell people in pitches was that, the stock market will return you 8 to 9% a year, but then every 8 to 10 years, you get a 50% drawdown. If you brought that in to me to look at as a manager, I'd throw you out. I mean, it's like a terrible overall profile for a sort of a money manager, but people just buy and hold, and that's fine because I understand the long-term point of it. Can we touch on the dollar really quick? And then I've got one last viewer question I want to throw your way that's sort of currency related. I was looking at the Canadian dollar today because yesterday they had pretty strong inflation figures, and they had paused and then they came back and hiked again for June and July, and then they paused again, and then their inflation bumped up, sort of like you're predicting for the US. And I thought this is interesting to me that the Canadian dollar hasn't budged. Now, obviously, there's the crude oil part of the Canadian dollar reflection there. What is your stance on the dollar? And then I want to ask the last viewer question before we let you go, if that's okay.
So bigger picture, I like to say that, the thing about the dollar is that there's a lot of different rhythms in a lot of different currencies. So they're going in different ways. But in general, over the last month or two, the dollar has been rebounding. But what I find it's most interesting to look at is we hear all this talk about de-dollarization. The dollar's going to stop being the reserve currency. I tweeted out something last week from Newsweek magazine. No, it's Business Week magazine in 1978 that this is the end of the dollar as reserve currency. Hey, 45 years early. It's just being early, right? It's not being wrong. I'm just early by 45 years. But the problem with this is that the Saudis and the Russians, and the Turks and the Indians, and maybe the Brazilians are all going to get together and they're going to form this new basket that they're going to price commodities off of, like oil. Go look at all their currencies. Go look at all of those. All those currencies are collapsing right now. I mean, they're getting pummeled. Yes, you're going to price. You don't like the dollar because a dollar today is a dollar tomorrow. I want to price it in something today. It's going to be worth 90 cents in a few weeks. That is insane. They are, right as they are trying to de-dollarize everything seems to be falling apart. So you sum it up, I think that the dollar is fine right now. Fine as a chart pattern. But if you wanted to ask me, but we've got this deficit, and we've got all these other, look, you're going to get no complaint from me or no pushback from me that the U.S. economy and the U.S. fiscal situation is not in a good spot. But the benefit that the U.S. has is everybody else is in a worse spot, right? It's a riff off of the old Winston Churchill line that capitalism was the worst form of the government ever made, except for every others. The dollar is the worst reserve currency ever created, except for every other option that we have, and that's kind of why we're stuck with the dollar for 45 years, and it continues to be the reserve currency. Find me a true alternative. And not that the Saudis and the Russians take their two collapsing currencies and put them together into an index and say, here's the alternative, because it's not an alternative to the dollar.
Okay, so now when I read this question, you can basically say asked and answered, just because that's basically what this question was. The question is, do you have an opinion on how the BRICS alliance will affect the dollar's position in the world economy?
You know what?
I think he does.
I'll throw in one other one. I'm looking over at my Bloomberg, and Milei, who's now the leading candidate in Argentina, which has 113% inflation, and he's kind of a right-wing libertarian candidate. He just announced that if he wins and he's leading in the polls, he's out. He's out of this. He's going back to the dollar. He's going to take Argentina back to the dollar. He's not interested in talking about anything for de-dollarization. So it looks like they're about to lose Argentina in this whole argument. The last thing I would say, if you look at, if you guys have interviewed Brent Johnson with the milkshake theory and stuff, he has a very good riff on this about the number of times that the Russians and the Saudis and the Brazilians have all said, this is it. We're done with the dollar. We're going to put our own scheme together that this is like the 6th time in the last 15 years that they've tried this. The other 5 times, half of them, they didn't even finish with it. They just kind of made an announcement that we were going to do it and then just dropped it. So, I'll believe it when they see it. I'll believe it when the Saudis actually force the rest of the world to pay for oil in a collapsing currency as opposed to the dollar. Show me, they'll do one transaction with the Chinese and say, this is the beginning of, okay, fine. When you tell Exxon that they have to now come up with zillions of dollars, and that's a technical term, zillions of dollars of this new basket of currencies to pay for all the oil from the Saudis, then maybe we could talk about it. But I think this is going to wind up a big bunch of nothing. Like I said, if you want to tell me about all the problems with the dollar, agreed. But then I said, look at every alternative. They're worse. And that's why the dollar will stay where it is.
And to underscore that real quickly, when Fitch downgraded us, which is essentially a downgrade on the dollar, because what they're saying is you're going to get paid back in garbage currency, the dollar rallied when there was slight disruption in the market. So yeah, as soon as things hit the fan, people will go to the dollar. It's the only thing.
You know what? Just to reiterate that, you saw that in 2020, and you see that everywhere else. Look, we're talking with primarily an American audience. We don't have to worry about currency exchanges, right? Because we all deal with dollars, but the rest of the world doesn't. And so in the rest of the world, when something hits the fan, step 1, put all your money in dollars. Step 2, figure out what just happened. And that happens over and over again. Every time everybody starts hyperventilating about anything, they all run to the dollar. Even if it's that the dollar was downgraded, they run into the dollar because they know that if the dollar's worthless, then everything else is worthless too.
We got bigger problems. Okay,
yeah, exactly.
as we told you when we invited you on the show, we'd have you on for 15 minutes. But as you also know, we lie quite a bit, and you've got a lot longer than that. And the next time we say it to you, you're gonna maybe hopefully fall for it again, and we'll keep you on longer anyway. But it's so good to have you. Thank you so much.
Thank you. You guys need a Major League Baseball pitch count, I guess, is what you need.
That's what we do need.
Or a pitch clock. Excuse me, a pitch clock.
Get them out. Yeah, pitch clock. Yeah. Right.
All right. Thanks, guys.
Thank you very much,
Jim. Thank you.
Yeah. He's too smart, Bobby, isn't he?
Honestly, I mean, the fact that there was twice where we had viewer questions and he answered them before I could put them up.
Exactly.
All you gotta do is bring up the subject.
Okay, so there's a couple of markets I want to talk about and get down to things that are a little more granular in the trading world. He mentioned oil. I think oil, I look at that chart, I keep thinking something wild's going to happen. Can we put up an oil chart and talk to it?
Sure. Let me get that together while you babble.
Yeah. Okay. What should I babble about?
Talk about
Just
your
kidding.
view on crude right now. Talk about your view on crude right now while I put it up. And I'm going
Okay.
to put up a
So
WTI futures chart.
what we're looking at in crude is crude has several times bumped up to a very, very important level, which is seems to me just south of the 84 level. It's 80 to 84. You'll see on the chart too. My contention is this. Jim mentioned the fact that OPEC is standing firm in their production cuts to keep the price of oil high. Remember that just 2 short years ago, we started this asinine plan of selling from the Strategic Petroleum Reserve here, trying to depress the price of that product that those people in OPEC sell. They're not going to be happy about that. If you put a hamburger joint next to my hamburger joint in Palatine and tried to replicate my recipe and sell it for half price, you wouldn't be my friend anymore. So I know that they claim to be our allies, things too, but I have this feeling that when crude starts to run, and I think it's a settlement above 84.5 in the crude futures, I think it's going to start to run. They're going to smell blood in the water that the U.S. has to, at some point in time, restock the SPR, and I think they're going to run it on us. What do you think, Robert?
I agree. Let's put that chart up there that I just put in the hub here. So if you look at this, and I'm going to expand this a little bit so it's just a little bit more clear on recent moves. What we had here is kind of a classic breakout to the upside that then kind of slowed and pulled back and seems like it might be kind of losing its steam. But the true support here to me, and this is a daily chart, you can see where I have the cursor here. That's the first breakout of the 200-day. Okay, so we can get all the way back there and it doesn't necessarily change the new trend in crude oil. Now, from a fundamental perspective, both the EIA and the IEA, both captured and useless, in my honest opinion, have said that the U.S. is going to blow production estimates out of the water the next 2 years. Okay, and that's based off of the earnings reports from the likes of Exxon and Chevron and to a certain degree Oxy, who kind of blew away their estimates for the second quarter in terms of production. But I mentioned this last time and I'll mention it again. Exploration has been turning up about half of the barrels equivalent than it has in the past, with about 42% more money spent on exploration. So, as I mentioned before, I'm going to mention it again, shale rigs produce the bulk of the production for the life of the rig early on. That's why we're getting these just blasts of production now. And this particular sort of easing of price that might come off of something like increased U.S. production over the next, say, 6 quarters is not going to be enough because OPEC will adjust to it and then there won't be supply to replace it. So you are absolutely right in my view. They don't like us right now. They don't like this administration. There's no guarantee they'll like the next one, whether it's the same one or a new one or a former one. I don't know how they feel about the former one. I'm not in their heads. But they don't like this, and they don't like what we did to them a few years ago in terms of their budgets. So, yeah,
that's
I
what I
totally
believe.
agree with what you're saying.
Now, that being said, when I look at that chart, I see the big opportunity is when we get that settlement above 84.5. Gun to my head right now, and you said you have to make a trade right now. I think I would, as it's pulling back and it feels like it's losing momentum from trying to break those highs again, I would say I'd put a short on for a short-term trade, although that's a very, very low conviction trade. Again, and I don't – patience is the better part of valor in the trading world. But you agree that the very shortest term momentum, it looks a little bit negative, right?
Yeah, I agree with that. Now, it's funny. 2 guys on this show, which right now it's only you and me, so it's clearly who I'm talking about, have both have parted ways with a large network in terms of being contributors to that network. You and I both did that. And in part because they put guns to our head at certain times, right? They said, we want you to argue about this, or they said, we want you to put on a trade in this commodity, or what. That was the specific story with me, is they said, hey, crude oil's up 7%. We want you to figure out a trade. And I said to them, I'm not doing, it was copper actually. I said, I'm not doing copper up 7%. That's stupid. And they said, well, you need to put on a trade. So I said, well, okay, if copper falls 6.9%, I'll buy it. And I said that on the air, and they got really mad at me, right? And so that's the way that I look at crude oil right now. My overall view on this crude oil, let's put this chart up again one more second. My overall view on this crude oil chart specifically is that I don't want to short it here because there's several areas that can hold up. There's this
Oh, I
area
like
right
that. I
here.
see it now.
Yeah, there's this area right here that comes in around 79, 80, 78, $79 that could hold up pretty strongly. There's this area right here at about 77.40 that could hold up. There's this area here at 76, and you might be saying, I could make a lot of money on the way down there, and you'd be right. But for me, I would rather wait for a basing pattern and then a move back up because my larger view is higher. And then you look down here, and these are estimated volumes, right? Look at the low volumes on the down moves and the high volumes on the up moves. I like that from a bullish perspective. So yeah, gun to my head, I'll say exactly what I said to that network, who I won't say who they were, CNBC. I would basically say, no, I'm not doing anything here. I'll buy it lower if it holds.
Right. I like that a lot. Let's move over to
CNBC
stocks.
story, by the way.
Yeah.
Yeah. Yeah, I'll just switch this to an S&P or to an SPY chart if you want.
Yeah, SPY or the futures, either way. SPY probably more of these people who are watching probably look at that. So people, before we get that up, if you guys follow me on Twitter, watch me, I believed it started about 3 weeks ago. We had a day where we had a kind of seemed like a blow off top, higher high, lower low, closed on the lows. And then as soon as we broke that, which was about a week later, I believed, there it is. I believe that's, you see the day at that. I believe that we were heading lower, and I positioned for that. I'm comfortable with that position. I still believe that approximately 8 to 10% correction is in the cards. What do you see technically that would dissuade me from that, or pat me on the back?
I'm patting you on the back because as you see, if I bring my cursor right here, you can see this little gap here. Now, gaps need to be filled with recent price action, not with past price action, in order to be technically correct. That doesn't mean a lot of people think this was a gap fill here, but it's not because the gap hadn't even formed yet. So that's just silly. The gap got filled and we blew through it. Okay, so my view on this is there's more downside to come. Now, having said that, you see, it's too much to explain why I have this red line here. Crap, I wish I could have shown you guys this chart yesterday because you see that red line was already there. I didn't just put it on the low and go, look how smart I am. I picked the low. I don't have a position on. So my position would be the opposite of what I have for crude oil. If I can get a rally back up somewhere in the SPY, I'll call it 446.50, but it can go as high as 447.50, 448. If I can get a short up there, I'll take it. I think there's more downside here. And then if you look at like a longer term chart, and then we can go into the fundamentals of this if you feel like it.
Sure, I'd love to.
Look at a longer term chart here. So you guys will have Mike Arnold on this show. He's my partner in Path Trading Partners. He's one of the best technical analysts. To me, him and Carly Garner are the two best in the world. This is something called the rotation zone. And we look at this on a weekly and a daily. You can go all the way down to the bottom of this rotation zone and the weekly trend has not changed. Okay, you can go all the way down to the bottom of it. You can even break it and have it turn back up and re-enter it, and we're still sort of in a bullish pattern. So I like the shorts here. I like trading from the short side. I just would rather see a rally back up first.
Can you tell the people what the rotation zone is, what those two moving averages are?
Proprietary. We actually, it's funny, on our website, we sell the rotation zone course, but I think it's like $9. It's like we don't make any money on it. It's just something out there so that we can claim it actually is ours. It's actually his. I'm stealing it from him. It's the 8 exponential moving average. And the only reason I say 8, it's 8 period. So if you're on a weekly, it's an 8 week. If you're on a daily, it's an 8 day. Okay. 8 period exponential moving average, 21 period exponential moving average. And it applies to the period you're looking at. And you want to see it widening and moving in a direction. Okay. So in other words, I feel like this is important to say. So let me just do this. In other words, if I look at the chart here in this area here, can you see where my cursor is, Jimmy?
Sure.
That's not a rotation zone because it's flat and it's moving horizontally. Okay. It needs to be moving vertically and preferably widening out for it to be a rotation zone that I can actually consider taking a trade off of or even taking any advice from.
Right. Okay, that's interesting.
Yeah.
Okay, cool. What do you want to look at next?
Actually, can we look at the 10-year note? Now, this I'll put up the futures. And would you rather see the yield or would you rather see the?
I think people, particularly retail traders, like to see the yield contracts more than the other ones, even though the other ones are more widely traded, but they're more of an institutional use.
All right, it's going to take me a second to pull this up, but here, I'll find it real quick. This is where I start to look stupid because I don't know the actual symbol of the 10-year yield, and I want it to be here. This will work. Okay, there's your 10-year yield.
I'm not even sure I know how to spell yield. Is it IE or EI?
That's a weekly. Let me get my measurement out of here because that doesn't apply to today. So this is a daily 10-year yield. Now Jim talks about yields going higher, right? Am I misrepresenting him here?
No, Jim Bianco talked about
Bianco.
yields going between 4.5%
I'm
and
just going to call him
5%.
Bianco. Now look at look how far back we have to go to compare it to some previous price action. I just keep compressing the chart on the screen. You have to go all the way back to 2022 to even compare these areas. So right. I don't even want to talk about it from a technical perspective. Let me ask you, when we have such a long time that we haven't reached a level like we have here, right? I mean, I can just start going back and it'll just turn into a blank chart, right?
We're not going to blow through it the first shot.
We're not going to blow through it on the first shot. So when we get up here a second time, is that significant to you?
Then it'll be significant. But I love where you were going with that question too, because you see a chart like that, seems like a lot of energy will be used in getting to that level. Yeah. It's like when a football team comes back from a 30-point deficit. Oftentimes, and this is statistically accurate too, there is somewhat of a letdown, once they tie the game up, which is interesting to me. But I always think of it the same way in this too. There's a lot of energy expended getting to those highs, and I have a difficult time believing it's just going to blow through it like it's a yield sign.
And for people who think this goes against, like if we predict higher yields, it doesn't go against Jimmy's thesis that the Fed's going to need to come in and cut rates because the 10-year does not apply directly to what the Fed does. The 2-year does. And not even that's direct, right? Right. You're looking more in the 1 month to 3 months to see an actual effect on yields. The 2-year is where sort of the bond guys will look at and say, okay, this might be dictating something the Fed might do. The 10-year out to the 30 goes more to mortgages and inflation expectations. So you could have a Fed that's cutting rates, and then you can have a market that agrees with Jim Bianco that inflation is starting to move higher and it has sort of fuel in the fire of moving higher, and these rates can just shoot up. And that's going to be the writing of the curve that we need to see, that to me is going to indicate that stocks have bottomed in a real way. Not just they bottomed in October off of a shock and we got a 9% rally off of that.
So tell me, can you make this chart more like a 240-minute bar, like something much, much shorter? Because when I look at this, and this is actually for my benefit, because I will think about shorting yields if we see a pattern for a short-term trade, about shorting yields if we see a pattern where it looks like it's, clearly running in to a difficult time. We saw that on the long-term chart, but I see nothing here to suggest that right away. I'd have to see a bit of a sideways trade and then a move lower off that low. Maybe even if you go into the rotation zone, it's a significant area. You could still make some money on the short side, shorting yields. Do you like that, or you don't love it?
Well, what we've got here, and my mouse is just
failure to communicate.
what we've got
have here. Sorry.
Are you correcting my Chicago English? Is that what you're doing?
No, I was doing Cool Hand Luke. What we have here is failure to communicate.
Yeah. So does that make, I haven't seen that movie in forever. I'm not sure. I'm going to take that as a compliment, but I don't think it was.
No, it certainly wasn't.
Okay. So what we have here is a potential double top. Okay. This is not even a correct double top. It's potential. Right. We need a down move, and then we need a trade below the base to get a confirmed double top. Now, this is a 4-hour chart. Like how quick I did that math, 240 minutes is 4 hours.
I love that. Well done. Yeah.
So right below this level, if you get a close below this level, then you have a confirmed correct double top. And then we could do a measured move off of that, which I'm just eyeing it is probably somewhere around these highs would be the target on that, somewhere in that range. Right. I'd have to measure it out.
By the way, that's precisely what I was thinking of when I saw that too. I didn't articulate it as well as you did, but that's what I'm talking about. And I'm not
well, you'd also,
that's really what
you'd also, and let's zoom in on that. You'd also be closing through the rotation zone at the same time. Right. So if you got to close below here, you'd also be closing through the rotation zone and into kind of this area where there wasn't much interference for the move higher. So that's a pretty viable trade that might have triggered by next week that we can take another look at.
So deep down, I've been meaning to ask this question. I should have asked it when Jim was here. We had three extremely Italian people, but I always I look at you and I we're like street Italians, where he's refined and sophisticated. Do you get that too with him, by the way?
Yeah, he's just smarter than us, and I hate it.
Yeah,
he's like the kind of guy.
Yeah,
the kind of guy in high school.
You go.
No, I mean, I'd be trying to throw punches at him, trying to knock his books down. He could probably take me if I'm being honest. But
he's from Melrose Park, which for you people around the world here, very, very Italian neighborhood. And when you start to get him talking about Italian restaurants, then the hand starts going. Then the voice changes a little bit to the overbite air guy. Yeah. So I think that's what I like when Jim Bianco does.
Yeah, if you get Jim Bianco drunk, I don't even know if he drinks anymore, but if you get him drunk, man, you're going to hear the D's and Do's and, the 1, 2, 3 and all that stuff. Hey, quick question, and this is to you, Jimmy. This is just came on the screen now, and it's kind of your bailiwick. Would you do a trade using puts to short yield? And if so, what kind of strategy would you choose?
So when you're shorting yield, I have no experience with trading the options in either the TLT, the ETF, or the micro yield futures contracts. But either way, so if you're using options to put on a lower yield trade, you would have to buy a call spread in the CME 10-year futures, because that's just priced in real bond prices. So when those prices go higher, it means yields are coming down. So if that person wants to contact me on Twitter, I know that most of the people who are listening to this show trade more in the ETF world and cash equity, whereas I've gone I trade both those things, but I'm talking about doing it in futures too. So the TLT, Bobby, I'm gonna throw back to you. That's the same. That's bond prices. So if TLT is going higher, that means yields are going lower. Correct.
Correct. And here
that would be a call.
Well, what I put on the screen now is that 4-hour 10-year note futures chart. So you're seeing a very similar move, except that sort of little double top on the yield, which would have been a double bottom here, broke already. So it failed, right? So that's actually it already basically triggered in the future side, is what I'm trying to say. Right. So if you're going to see yields going lower, you want to see this going higher. Right. And we haven't necessarily see that. This seems to be breaking down more. So you do see that sort of disconnection every once in a while, and it rights itself. And I would suggest if you're looking at yields and you see that the futures chart doesn't really match, you want to wait till it rights itself and reassess.
Good point. And I will like to reiterate that I was talking about seeing a pattern. My inclination was for lower yields, higher prices in bonds, but I wanted to see a pattern that would lead me to make a trade. And so far, I have not seen that yet in either market, really. But to answer the question, I would do it by putting on either call spread in TLT or a call spread in 10-year notes to try to capture a quick move lower in yields, if that makes sense. Good?
It does, and that's an hour. God,
That's an hour.
This felt like 10 minutes underwater.
We could keep going all day. Yeah, it's so funny. We tell you, we're going to have your 15 minutes. I swear to God, we'll get you out of here. It's like almost 40.
Hey,
all right.
His fault. He trusts us. I tell you guys before you go, next week we got Jim O'Shaughnessy. He's just an absolute legend. Week after that, Cameron Dawson. Then we might have, actually, a week after that, I think I have a special guest co-host on the show, but we'll talk about that as approaches. So check us out next week. We got Jim O'Shaughnessy. Look him up on Twitter. Absolute legend. Everyone I talk to, I just say his name and they're like, oh my God, where do I watch?
Right. So the moral of the story here is, even if all these people are watching think that we are full of crap, you must admit that for some odd reason, we get great guests. And we should close on that.
Yeah, we're closing on that. We're done here, guys.
See you. Thank you.